In the corner of southwestern Spain, there is a river that runs a color of deep copper and dried blood. For 5,000 years, from the era of the Chalcolithic miners to the Roman emperors, this red river, or the Rio Tinto, has witnessed extraction of the Earth's most vital treasures. In 1873, a group of British investors backed by the Rothschild family purchased the mines from a struggling Spanish government for nearly £4 million, birthing what would become a global industrial titan. This company was not merely an extractor of minerals. It was an architect of the modern world, providing the raw materials for the Industrial Revolution and the subsequent rise of global superpowers. Today, this $80 billion behemoth is a study in structural dominance and geological luck. As we begin our forensic deconstruction of Rio Tinto, I want you to focus on one specific number, 14. This number is the invisible shield that protects the company from the volatility of the commodities market and explains why they can survive when their rivals collapse. Hold that number in your mind as we peel back the layers of this mining fortress. The evolution of Rio Tinto is a saga of aggressive expansion and calculated risk. From its Spanish origins, the company rapidly moved across the globe, establishing a dual-listed structure in 1995 through the merger of the British RTZ and the Australian CRA companies. This move allowed them to access capital markets in both London and Sydney, providing a level of liquidity and strategic flexibility that few in the sector can match. They outmaneuvered early competitors by securing the rights to the Pilbara region in Western Australia, a geological anomaly containing some of the highest-grade iron ore on the planet. While others were searching for gold or diamonds, Rio Tinto was focused on the unglamorous but essential bulk commodities that would build the cities of the 21st century. Their strategic pivot in 2007, marked by the $38 billion acquisition of the Canadian aluminum giant Alcan, was a massive bet on the lightweight metal of the future, though it nearly broke the company during the great financial crisis. That survival shaped the disciplined, cash flow-obsessed entity we see today. To understand the operational engine of Rio Tinto, we must dissect the four pillars that generate its massive wealth. The undisputed crown jewel is the iron ore segment, which generated $32.4 billion in revenue in the last fiscal year, representing 60% of the total group revenue. This is the highest margin business in the entire mining industry, fueled by the vast mines of the Pilbara, where they operate an autonomous railway and trucking system that looks more like science fiction than traditional mining. The second pillar is the aluminum segment, contributing $12.4 billion, or 23% of revenue. While aluminum is more energy-intensive and has lower margins than iron ore, Rio Tinto holds a competitive advantage through its ownership of massive hydroelectric power stations in Canada, allowing them to produce green aluminum with a significantly lower carbon footprint than Chinese competitors. The third pillar is copper, generating $6.5 billion, or 12% of revenue. With the recent full acquisition of the Oyu Tolgoi mine in Mongolia, copper is set to become the primary growth engine for the next decade. Finally, the minerals segment, including borates, titanium, and diamonds, provides $2.7 billion, accounting for the remaining 5% of the pie. Geographically, Rio Tinto is inextricably linked to the fortunes of the East. China remains a dominant customer, accounting for $32.4 billion in sales, or 60% of total revenue. This concentration is a double-edged sword, providing massive scale but also exposing the company to the fluctuations of the Chinese property market. The rest of the Asia-Pacific region, excluding China, contributes $6.5 billion, representing 12% of revenue. The United States is a significant and growing market, providing $8.1 billion, or 15% of the total, driven by the demand for copper and aluminum in the domestic energy transition. Europe and the rest of the world provide the remaining $7 billion, or 13%. When we benchmark this against BHP, their primary rival, Rio Tinto shows a higher concentration in iron ore in China, whereas BHP has a broader exposure to metallurgical coal and potash. Compared to Vale of Brazil, Rio Tinto possesses far superior logistical infrastructure and a much lower geopolitical risk profile. Fortescue Metals Group, while a formidable competitor in iron ore, lacks the diversification into copper and aluminum that gives Rio Tinto its industrial breadth. The forensic deep dive into the balance sheet reveals a company that has learned the hard lessons of past. Rio Tinto maintains one of the cleanest balance sheets in the entire material sector. Their net debt currently sits at approximately $4.2 billion, resulting in a net debt to EBITDA ratio of 0.3 times. This is exceptionally conservative, especially compared to the high leverage seen in the early 2010s. Their interest coverage ratio exceeds 35 times, meaning their debt obligations are virtually an afterthought compared to their earnings power. This financial strength allows them to maintain their capital expenditure programs and dividend payouts even during periods of low commodity prices. The operating margins tell a story of two different worlds. The iron ore division enjoys EBITDA margins of nearly 70%, a figure that would make most software companies envious. However, the aluminum and mineral segments drag the group operating margin down to a more modest, yet still impressive 42%. This margin profile is superior to Glencore, which relies heavily on trading activities with lower margins, and is roughly in line with a high-grade production of BHP. When we examine the long-term growth metrics through the lens of compound annual growth rates, the forensic data reflects a cyclical but upward trajectory of the company. Over the last 5 years, revenue has grown at a compound annual growth rate of 4.2%, a period characterized by high iron ore prices followed by a normalization in Chinese demand. Extending the horizon to 10 years, the revenue compound annual growth rate is 5.1%. On a 25-year basis, which encompasses the 1995 merger and the entire China supercycle, the revenue has compounded at an impressive 7.3%. The free cash flow story is even more robust, reflecting a management team that is focused on capital efficiency. The 5-year free cash flow compound annual growth rate is 3.1%, while the 10-year rate is 6.2%. Over the 25-year period, free cash flow has compounded at 8.4%, outstripping revenue growth and indicating a massive increase in operational efficiency. This ability to generate cash regardless of the price of ore is what allows them to remain a favorite of institutional dividend investors. The dividend fortress of Rio Tinto is built upon a transparent and disciplined capital allocation framework. The company has a policy of returning 40 to 60% of underlying earnings to shareholders as an ordinary dividend. In years of exceptional performance, they have historically paid out significant special dividends. The current absolute payout per share stands at approximately $4.30 annually. Based on the current free cash flow, the payout ratio is a highly sustainable 55%, which sits comfortably within their target range. This results in a current dividend yield of approximately 6.6%, one of the highest among global large-cap companies. When we look at the dividend compound annual growth rates, the numbers are striking. Over the last 5 years, the dividend has compounded at 5.2%. The 10-year dividend CAGR is a massive 14.2%. Though this is somewhat skewed by the low starting point in 2016. Over 25 years, the dividend has grown at a compound annual rate of 11.5%, significantly outpacing inflation and providing a powerful shield for long-term income seekers. Furthermore, the company has utilized share buybacks strategically, providing a buyback yield of approximately 0.5% over the last 5 years and 0.8% over the last 10 years. Despite its fortress-like financials, Rio Tinto faces risks that are as deep as its mines. The primary threat is the decarbonization of the global economy. While copper and aluminum are essential for green technology, the production of iron ore and aluminum is carbon-intensive. The company is investing billions into Project Elysis to create carbon-free aluminum smelting and is exploring green hydrogen for iron ore processing. But the technological hurdles are significant. Geopolitically, the reliance on China is a persistent vulnerability. Any significant trade conflict or a permanent slowdown in Chinese infrastructure spending would hit Rio Tinto harder than any other mining major. Furthermore, the Simandou iron ore project in Guinea represents a massive capital commitment in a politically unstable region. While Simandou will provide Rio Tinto with the highest grade iron ore in the world, the project has been delayed for decades and remains a focal point of geopolitical maneuvering between the West and China. The forward guidance for the next 1 to 3 years suggests stable production volumes with focus on cost control as the company prepares for the copper growth phase from Oyu Tolgoi to reach full capacity by 2028. Now, we must close the loop on the mystery number we established at the start of this archive, 14. That number represents the cash cost in dollars for Rio Tinto to produce a single ton of iron ore in the Pilbara region. When you consider that iron ore prices, even in severe bear markets, rarely fall below $60 per ton, you begin to understand the sheer magnitude of their margin of safety. At a cost of $14, Rio Tinto is the last miner standing in any price war. It is an industrial insurance policy that guarantees survival and dividend payments when others are facing insolvency. This cost advantage is a result of 50 years of investment in infrastructure and technology that cannot be replicated by any competitor. It is the reason why, despite the volatility of the commodity cycle, Rio Tinto remains a cornerstone of global dividend intelligence. The cash verdict on Rio Tinto is clear. It is a high-yield, cyclical powerhouse that serves as a vital inflation hedge in a diversified dividend growth portfolio. However, because of its cyclical nature, entry prices everything. Based on a current free cash flowed enterprise value yield of approximately 9%, the stock is currently trading at an attractive valuation relative to its historical averages. For the disciplined investor, a buyer's entry price range of $58 to $63 per share provides a significant margin of safety. On the weekly technical chart, the stock has established a strong base of support at the 200-week moving average, which currently sits near the $60 mark. Purchasing near this level has historically yielded superior long-term returns. While the road ahead will be dictated by the pace of China's evolution and the success of the green transition, the $14 cost shield and the pristine balance sheet make Rio Tinto a fortress that few can breach. Thank you for listening to this archive. I am Cash, and this was CASJ Global Dividend Intelligence. Stop guessing. Start knowing.